Well, I would normally say, hey, Harry, how's it going? But Harry has decided not to be with us today. He's out working on his golf game. And so it's just me, Colin, today, and great guest I'm excited to have on, Nick Tippmann. Nick, how's it going?
Hey, how's it going? Doing well, Colin. Pleasure to be here. Excited.
Awesome. Well, we're excited to talk angel investing, and in particular, I think you've got a unique POV on vertical SaaS. So I'm eager to dip into that. We had a guest on a week or two back that talked about dev tools and DevOps, and we learned a ton about that. So we're really excited to kind of get into more of some of these, like, I don't know if I call it niche, but very specific
Yeah.
areas of like expertise and talk about it. And because there's I think vertical SaaS in particular, I know a little bit. I should let on. I'm not a total don't know anything. It's become more popular recently, and I think
Yes.
fun time and topical to hit on it. So I'm gonna do your quick bio, and then we'll jump right into it. So just to introduce you to the audience, Nick is a operator and founder turned investor and advisor, similar to my path and things. He's currently an active angel in 50 plus startups and LP in a number of leading emerging funds. He's also angel investing, specifically focused on early stage B2B vertical SaaS companies. But prior to that, when he was working and getting the W-2 paycheck here, Nick was the CMO and part of the founding team at Greenlight Guru, a pioneer of the vertical SaaS model for medtech companies, where they bootstrapped from zero to tens of millions in ARR and raised 120 million from a top tier one PE firm in about 2021. So you've done it both. You've raised money, you've bootstrapped. You're like, you might be the unicorn. But prior to that, Nick was a founder of three startups that I think didn't quite reach exit velocity, but probably really set you up for that fourth one in success. And Nick, he went to Indiana University and lives in Indianapolis. Though I don't want to give anything away, I've heard tell that Austin is a line of sight and an interesting place per your Twitter. So
Yeah, I don't know. I'm looking around. I've been in Indianapolis and Indiana for most of my life, and Greenlight was headquarters there. And now have some time to pull my head up and look around and kind of explore where I might want to live next. And there's a great community, great startup world in Austin. And I don't know that like the weather and I like what's going on down here. So we'll see.
nice. Yeah, we've loved Austin. We moved here almost 5, 6 years ago. Breakfast taco capital of the world, so that's like a personal favorite of mine, and queso. So margaritas. I mean, there's a lot to love. All right. Well, let's jump into, like, we're gonna do our quick hitting questions that Harry usually does, so it'll be a little bit different, my flavor. But first of all, so we can get to know you a little bit better, how many angel investments you've done? We know 50 plus, but how many are you looking to do this year? Kind of cadence. What's your plan?
Yeah, so I'm looking to do probably about 30 deals this year in total. Roughly comes out to about two, a little more than two a month right now. So yeah, I'm about halfway through that right now. So I've invested in about 15 companies so far this year.
Oh wow! So you're like ahead of schedule. Q1, Q2. You're pacing fast.
I am pacing fast and I've got a lot moving with my strategy. It's a fruitful time, I think, in the market as people, your views on it. But it's an interesting time right now, and I think if you have the right head and stomach for it, I guess you could say, I think there's a lot of opportunity to be capitalized on right now.
There's certainly a ton of deal flow, more than normal, I would say, and so that's exciting from that perspective. And in terms of check size, what are you normally doing? What's your target?
Yeah, so they're definitely smaller checks, typically 3 to 10K. I got a couple that are 25K and above, but really it averages out right around that 5K mark.
Got it. And what, in terms of, we know we focus on B2B vertical SaaS, but what stage do you like? What's your sweet spot?
Yeah, sweet spot's definitely probably the seed stage, early stage, got a product, maybe a little bit of traction, really looking for a great founder market fit at that stage. But really we'll go all the way down into the pre-seed and up. Really, I've done some Series A plus this year as well that I'm really excited about, but really try to keep that sweet spot in the early stage or seed stage.
That makes sense. Cool. So let's dive into the bread and butter, the vertical SaaS. Maybe you can give us a little backstory. What is vertical SaaS? Tell us a little bit about pioneering that model, and then we can ask some more questions from there.
Yeah, for sure. So vertical SaaS, as you mentioned, Colin, kind of kicking it off, it's pretty hot right now. A lot of people talking about it. And really the way that I've seen it, and a lot of VCs have written about this, so you kind of software 1.0 mainframe, software 2.0 was SaaS, software 3.0 is kind of this end user product led growth, Notion, Dropbox, Figma, and kind of software SaaS 4.0, really looking at vertical as kind of the future. And really kind of the difference, the example that I like to use is Salesforce, kind of synonymous with CRM, the original horizontal company that's gone wide into all verticals, versus Viva, which is kind of the quintessential vertical SaaS company, which was healthcare specific CRM. And so those are kind of two really good examples of vertical SaaS and horizontal SaaS, both going after CRM. So I guess I should say that Viva started as healthcare, life science, CRM, and now they've since branched off to be industry cloud for life science. But interesting take, they both started kind of with that wedge of life science CRM.
Got it. And so by vertical SaaS, it's like SaaS for a specific vertical. Is that the kind of the exact definition, I guess?
Yeah, to sum it up, tailored for a specific vertical or industry, whether that's automotive, healthcare, restaurants, you name it, barbershops.
Got it. And so, you kind of hinted there that like horizontal SaaS had kind of been the model, and very similar to like marketplaces from that perspective. A lot of the big marketplaces that popped up, like eBay, they're horizontal. They went across many different verticals. They started a particular wedge, but they, essentially carpeted the internet for a particular horizontal. So from that perspective, you had kind of mentioned before that there had been some reticence by investors and people to invest in vertical specific. Maybe talk us through like why that was and what do you think's changed such that people want to cut checks now?
Yeah, absolutely. It's a great question. So really the first time that I've saw the vertical SaaS thesis publicized was by Gordon Ritter of Emergence Capital back in 2014, I believe. And that was right around the same time that Greenlight Guru was founded, towards the second half of 2013. And around that time, when you talk to a lot of VCs and when we were out talking to people, kind of the conventional wisdom or the normal knowledge of what you heard from VCs is that vertical SaaS is great. It's a great place to build a great business and to do a lot of good, but it's not big enough to support venture-sized businesses. And what I think has really changed since then to now, one, just the tremendous growth of cloud computing in general, but then two, a little bit of your background in marketplaces and fintech, but what kind of these vertical SaaS winners have figured out, like Toast and Shopify and Mindbody, is that they're able to layer fintech products onto their vertical SaaS platform. And kind of the holy grail of vertical SaaS is to become the system of record for that industry. Yeah. And then once you are the system of record, you can then layer on fintech products and start taking a cut rate of all the gym classes for Mindbody or all the restaurant bills for Toast. And now that can represent 50, 60, 70% of the revenues for these public vertical SaaS companies. And now that VCs have seen that, and I think it was Andreessen Horowitz that first wrote the paper on this back in, I think, like 2020, somewhere around then, about how these companies were layering on fintech products. And they kind of did the math and the research to show that you could now 2 to 5x your average revenue per customer. And I think VCs and founders alike kind of saw that and have seen it come to fruition. And now here we are 2-3 years later, and it's a pretty hot sector.
Interesting. I guess what, it's funny to think about it from a marketplace perspective, because in a lot of ways, I feel like there are two ways of solving the same problem, but kind of coming to the same solution at the end, right? One is, on the marketplace side, it's all about facilitating transactions. It's really about, so connecting supply and demand. So really helping the business on the growth side. And then ultimately embedding deeper usually is what happens. What I call the marketplace plus model. It's like marketplace plus SaaS plus fintech, whatever. It's add these things on to embed deeper with that, either demand or the supply side customer, and then ultimately own their business, right? And so a lot of those SaaS products that get built are system of record kind of products. It's kind of interesting. I feel like it's two theses that are like converging in the same spot, just coming at it from a different investment perspective of where do you start? And maybe it's not an investment, but just a different build perspective. Do you have any thoughts on that?
Yeah, I actually couldn't agree more. And I think, Colin, you have all people with the expertise in the market have a really interesting perspective on this. And I really think you said it nicely there. It's almost like two sides of the same coin, just coming at it from different angles. There's a lot of people out there that call this vertical SaaS model really just SaaS plus rather than vertical SaaS, because it can happen in SMBs. SMB is very similar to vertical SaaS, and most vertical SaaS actually start as SMBs.
Yeah, no, it's fascinating. I like that it's almost like kind of expands my investment thesis. Like I've tried to be pretty narrow into marketplaces and this marketplace plus model. And I'm liking to getting some validation that maybe it's okay to start on the SaaS side and work your way towards the marketplace. Cause I've seen a number of people doing that really successfully. And, like you said, MindBody, acquiring ClassPass, like in some ways that is kind of the holy grail, putting them two together and then owning it all. From an angel investing perspective and really, any investing in the space kind of perspective, what are some of the things that you look for, at the beginning? You get the pitch deck, there's obviously the financial terms of it, but, if you're trying to evaluate, is this going to be a good and successful vertical SaaS company? What do you look for?
Really at the early stage, pre-seed, seed stage, you're really looking for founder market fit, or I'm looking for founder market fit. And I think that's particularly important in vertical SaaS, where you are disrupting for a specific industry. So typically you need to have an additional role on the founding team. So you terminally need a business person and you need the technology side, right? But in vertical SaaS, you also need the deep technical subject matter expertise. So I'm looking for, has someone on the founding team experienced this problem firsthand for 5, 10, 20 plus years and knows the industry? Because another benefit of the vertical SaaS model is that it's typically a winner take all model. Word of mouth does really well. Customer acquisition costs are low because of that fact. And so if you're kind of already embedded in the industry, not only does it help with the product, but it can help kind of get those initial customers and help with reference selling, which also is very popular and does really well in the vertical SaaS model. So I guess to round that up, so, yeah, the founder market fit is really kind of, to tie a bow on it, what I'm looking at the most. And then from there, kind of two, that's 1A and 1B, but then two is really the TAM. And what is their initial go-to-market strategy? What is their wedge? Are they getting traction with that wedge? What is the market dynamics around that industry? Is it a really laggard industry, or is it a more modern industry that already is using SaaS products and is used to using modern cloud software? So there may not be as easy to disrupt, and you may be going after incumbents versus, so the TAM, and then, kind of the market competitive look as well.
Flipping over to Greenlight Guru, because I think there's probably some really interesting things you learn there, doing the bootstrapping path, but then also going PE, which is not private equity for everyone out there. There's a little bit different than most of the companies we look at. People are angel investing and then ultimately hoping for an exit liquidity wise. So maybe talk to us a little bit about what did you guys do? Why did you choose bootstrapping and then ultimately PE? Just walk us through that. It's super interesting.
Yeah. So I mean, when Greenlight started out, we started out as a wedge, as a tool, and our founders, John Spear and David Duran, and John Spear was that subject matter expert that had lived the problem for 10 plus years, and David was the experienced entrepreneur that had built and sold a company before and kind of brought the CTO in, David Odmark, our CTO, and they kind of had that magic team at the beginning. And I kind of mentioned some of the talks with venture capitalists that we had there in the early days, and that David and John had as well, and some of the feedback that we got. And we did raise an initial seed round, a $1.2 million seed round, to get things kicked off the way. But then it was really from there that our decision at your traditional Series A and your Series B, where we decided not to take the money, because we really looked at our opportunity. We looked at the business, we looked at the market, we just evaluated our situation scenario, looked at opportunities, threats, and we really we were growing very quickly, very fast, where we wanted to be. And we really didn't believe that the money and the dilution that we would take on would correspond to an accelerant in growth rate. So we were growing as fast as we liked, and we were profitable, or at least break even. And so we were in control of our own destiny. The math didn't work for us. And so, as our CEO, David Duran, always likes to say, we kind of look at the market, look at the conditions, and figure out what our decision was based on that. And the market or the climate never looked right for us. And so we decided to keep on bootstrapping until it did make sense to bring on that capital partner. And we did see a bigger opportunity and something that we could go attack, that we did believe that having additional capital and a capital partner with someone that had done that before was the right move and the right time to bring them on.
Well, and honestly, for anyone that invested in your pre-seed, seed, rounds, you not taking dilutive capital later, I mean, I'm sure they would love to follow on, but it's also great for them in some ways, right?
Yeah, they did extremely well. Yeah, I think they're all very very happy. Those were some good conversations that David got to have.
Yeah, I mean, that's the everyone we get to talk to on here is, for the most part, had some kind of exit or some success in a startup, and then ultimately has gotten into angel investing, mostly likely because they know startups and they've seen a pattern recognition from their own experience, and they want to get back out there and kind of, I think, pay it forward, but also, potentially get another home run without necessarily having to do all of the legwork to get there again, which is can age someone a little bit.
It is a lot.
I don't see too many gray hairs, so you're good. Yeah. It sounds like, if I'm, looking at your experience, you had a great founding team with good founder market fit, solving their own problem in some way. There's a lot of what we hear. It's a common thread through a lot of investments is just having a problem of your own that you want to solve and a really good team behind it is really the recipe for success. So totally makes sense why your investment thesis is in line with that. Is there any times that you see kind of like evidence to the contrary or investments that you make to the contrary of that, and why?
In the contrary of outside of vertical SaaS, or
just generally? I'm just always intrigued. I mean, because we do hear different opinions. Some people are very much idea focused versus founder focused at the early stages, and I'm just intrigued if, do you make exceptions to the rule, and what gets you to make those exceptions?
Yeah, 100%. So when I started out angel investing about 2 years ago, and really have slowly but surely kind of picked up my pace and picked up my speed. And when I resigned from Greenlight about 6 months ago now, that's really when I picked up my pace and really had some time to take some time off and really explore, like, what do I want to do with my next decade of my life or so? Mm-hmm. Do I want to go be a founder? Do I want to do that? But at the time, I was a lot more generalist, so it wasn't the vertical SaaS focus. B2B SaaS, definitely more broadly, go-to-market SaaS, but also marketplaces and fintech, and there's a lot really cool stuff happening in LATAM, and I really like what's going on over in India. But I think I was listening to one or two of these podcasts getting ready for this, Colin. I think one of your previous guests said this too. And it felt a little bit like a fish out of water. Like, that's fun. It's intellectually stimulating to know those deals, but I don't have the deep expertise that I feel like I can make quick, fast, conviction, strong decisions quickly in those other areas. Yeah. So it's fun. It's fun to see that. And it was really, for the first 18 months there that I was investing, I really was looking at it as a learning experience as much as anything, trying to see as many deals and get as many patterns as I could. And I saw good deals, and I think they're hot, and I think they're going to do well. But over time, I've kind of narrowed in my focus and really started to develop conviction and an idea around a thesis, and now really want to get my name out there and kind of be known around vertical SaaS. So when those other top vertical SaaS founders are out raising, they can think of my name and kind of get a reputation for being helpful on the cap table as well.
The go-to guy for vertical SaaS. And I can relate with that. I think when I first started angel investing, not when I first started, but when I really got more active in the last year around just looking at a lot more deals, doing a lot more, I started to kind of open my aperture, which was fine. I saw a lot of really interesting and good deals, like you said. It took me a minute to kind of get back to being confident in just, hey, you know what? You have an edge in one thing and you know it really well, and you can go in and you can ask really smart questions quickly and make a decision quickly and have high confidence interval around what you're doing. And so that has actually helped me sleep better at night, making investments in really early stage companies, right? And make sure I'm not just, throwing money away. So I can relate, is what I'm saying, is that you kind of take this zig to zag to remind yourself that, high conviction comes from like some level of expertise in something and knowing it and adding value, I think, as well.
Yeah, I think that's very, very well said.
Kind of expanding out, I'm always interested to hear, like, what's the quickest the deal's gone bad on you? Have you had any just, you put in money and then they've gone out? Like, what does that look like?
Knock on wood here, but no, not yet. The portfolio is still very young and still early. So every company is still alive. Definitely had some do some extensions here and this year, and across all portfolios. I'm sure companies may not be all hitting the targets that they set out at the beginning of 2023 and kind of get kicked in the teeth there a little bit in Q1, but No, nothing catastrophic yet, but I'm sure they will come. I know that I will have them. Try to be ready when they do, but yeah, nothing yet. So we'll see.
Well, that's good to hear. I'm not trying to jinx you in any way. In terms of these extensions, it's kind of a question I've been mulling over a lot is what do you make of these, pre-seed, seed, series A, any of these like plus or extension rounds? What's your feeling on them? Are you open to them, not open? What are you feeling?
Yeah. Yeah. I was actually just having a conversation with another VC friend about this. And I think it's probably a little bit different from a VC perspective, but my own personal take on it, like I really like them. I really like them, or I really don't like them. I guess I should say they're kind of on the ends of the spectrum there on the distribution curve, because what I typically see is that you're coming in with one or two scenarios. Either one, the company's doing really well, they're growing really fast, maybe even faster than expected, but that means they're also burning faster than expected. Or the later stage markets are just closed right now. You can't raise that Series B, that Series C right now. And so I'm seeing some really good companies go out and raise Series A extensions at what they raised at a year ago. The metrics are doubled, they're in a great place, and they're just trying to get to where they can open up to that later round. And that's really exciting to me. Those kind of companies, I think, are some of the best deals, and I think could potentially have some of the best returns in this vintage. Now, on the flip side of it, the bridge rounds, because they didn't raise enough, they haven't found that product market fit, they're not being pulled up market, and they're still kind of going sideways or worse. The easy way is like if they're trending down and you're raising money to kind of save things, then that's a hard deal, and maybe that's kind of part of the cleaning process of kind of the free flowing money of the last couple of years getting out of the system. So we'll see. But if they're good and they're growing well, like I think they could be some of the best deals, and I really like them.
I share the sentiment. I'm with you on that. I think either they're not good, right? They're a bad signal. Or in a lot of ways, what I view them as is like everyone raised at elevated valuations pretty much in the last 2 years. And even if they have traction, the valuations have reset such that even at their current numbers, even if they had just done amazingly, or really at the valuation they probably raised at previously. And so, one of the easiest, most expedient things to do is really just, open these safes or whatever it may be and just raise on the pre-existing terms so that they're, not putting a lot of like effort into like the legal part or, really just opening a new round and what that means and setting a valuation, finding a lead on that. So there's an expediency thing here, which I think is important for a lot of people. But I also think in some ways they're just raising at the valuation they grew into, but raised at, because the market was willing to do a higher rate earlier, they're just kind of grown into what they really probably should have raised at this point anyway. I kind of view it as like their dollar cost averaging they're raising. Right? Like, not every point in the market has the same valuation, right? So, I think founders really get worried about this up round, down round. And it's like, well, there is a macro condition here that just changes everything. And you're just dollar cost averaging money into the company, right? As you sell your equity. Yeah. So that's kind of how I think about it.
I really like that. I think that's a great way, good framing to view it. No, yeah, makes a ton of sense. So I think those companies that can dollar cost average in, and they're probably just raising at their appropriate round. Like I think there's some really good deals. I've seen some good deals kind of that fit in that category.
And I think it's a good entry point for angels right now too. Like, because people are a lot more open to essentially smaller checks and just really kind of getting money in the door faster. And so I'm with you. I'm pretty excited about some of the opportunities I'm seeing out there, specifically in that area. So I'm not like, we had a guest, Kirk, who just, I think across the board kind of avoids them, but I think it's not a baby out with the bathwater from my perspective. Real quick, before we jump in, I want to get one more back on the vertical SaaS side. So having gone through it, and you probably talked to a lot of vertical SaaS founders, is there any kind of specific advice you'd give them in terms of how they, pitch, sell their company to, angels and institutionals? I'm intrigued to understand if there's something nuanced there that, you need to do it a little bit different than everything else.
One of the things that I'm looking for, I don't need you to pitch me the big TAM now, but I need you to understand how you get to that, which also shows me that you understand the vertical SaaS model, which shows me kind of a lot of connections of the thinking that you have. But if you're coming in pitching it for what it is, and I don't see that bigger vision, and I ask leading questions to get around that bigger vision, and I'm not seeing that story, it's not a definite no, but it does kind of show me where the founder is and what sort of coaching they might need. It's something that I'm seeing a lot of, and it's maybe not a bad thing because these subject matter experts aren't always your typical SaaS founders that are marketplace founders that have grown up in the startup world and like eat, leave, breathe, and live this stuff for the last decade plus, like you and I have, but are coming into it because they see a real opportunity and they need a lot more education. That's a sign for me that I just read it for what it is, but they may need more education, or we may need to talk, or I may need to wait 3-6 months and kind of see, all right, that dot's here today. Where are they going to go? How fast can they learn and pick this up? So that, yeah, that's one thing that I'm kind of looking for at the early stage. Maybe it's a little nuance to vertical SaaS.
Yeah, I mean, if your requirement is in some ways to get someone that has expertise in this field, like really good founder market fit, you may be necessarily picking people that don't have a lot of tech experience, right, in building technology companies. And so wrapping a good team around them is probably pretty important. So that's interesting. Now let's flip back to the angel investing side specifically and say, who are some of the angel investors that you look up to? Like who are you like, yes, that person, you should follow them and hear everything they have to say?
It's a great question. The people, when I came up and when I started in the whole startup world, like the people that I read was Brad Feld, Mark Suster, Fred Wilson. Like a lot of them aren't as active these days, but if you go back and read their archives and their blogs, there's a lot of really great stuff in there. And they talk a lot about angel investing too. And even a decade plus ago, they were doing a lot more early stage deals. So I think there's a lot of really great wisdom in what they're doing. I think from an angel or really the emerging fund market, I think is really interesting with a lot of emerging managers invested in a handful. But I think people like Go to Market Fund, the Council, M25, MKT1, Ganas Venture, like there's a lot of them like that I think are doing really cool and interesting things that are, I wouldn't call them super angels with the micro VC emerging fund manager space. I think is it Elad Gil that kind of Hunter Walk kind of were some of the early ones that pioneered this model. Sunil over at Haystack. So yeah, those are some that I would take a look at, but they're kind of at different stages of their careers and perspectives on the angel or the very early stage game.
Interesting. I'm seeing more people that have, with like rolling funds out of angels too, like people calling it like an angel fund, right? Like kind of an interesting, like there seems to be a meshing in some ways of, like micro small funds or syndications or, syndicates plus fund. There's just like it's kind of melding together a bit into a bit more interesting market of like how can we just get capital to companies, right? And not having these traditional lines like, is it an institutional VC or is it just an angel? They seem to be melding in my mind, and hopefully in a good way.
Yeah, definitely. See, I think it's a good on ramp with the rolling funds into these funds as well. And I mean, I guess someone like Go to Market Fund that's continued to raise bigger funds now, and I think to get up to there, but you're kind of seeing the gradual progression of a growing firm or a company there, and so I think it's making it an easier entry point, I would say, to blur the lines, to your point, between the angel and those initial syndicate and rolling funds that kind of then grow on.
Two-part question on this. So we've had a lot of guests tell us that like the best way to get into angel investing is LPing other funds, or at least get up to speed. So two-part question. One, would you recommend that strategy, LPing? And two, what do you look for in kind of an emerging manager in one of these funds?
One, yes, I think it is a really good strategy. It gives you, I think it's really helpful if you're not in the startup world too, in particular, to really understand the mechanics behind the scenes a little bit. I do think if it was between making investments yourself and going out and finding deals and investing in an LP, I still think the better way to learn is to go out and do your own deals and invest and get your hands dirty. If you're saying between the two, what's the better way? But it definitely is a good way. And I think if you're not ready to go do it yourself, it's a good stepping stone to get there. And then what am I looking for in some of these emerging fund managers? It's really it's kind of the same characteristics that you would look for in a startup founder. What's their vision? What's their mission? What's the GP's fit to the thesis? Is this someone that I can see building a large, great firm with multi-funds and that I could be in early? Do they have a good go-to-market motion? Are they out there? Are they getting good deals? What's their portfolio look like? I mean, kind of standard VC stuff, but then also it's very much like angel investing in a way.
Yeah, because they don't have a track record. I guess that's why I'm intrigued by, what gets you to throw money in the pot, other than liking angel investing. So you're investing somewhat in startup VCs, right? So.
Yeah, I guess to that point, I would say they have good GP thesis fit, and I know that they have access to top-notch deals. And I'm not going to go down all the examples here, but I think it really matters. Like if you have that network, you have that unique perspective, and you have access to those deals. It's kind of like the trifecta. Are they a person that like I want to be around in this investing space for the next 10 to 20 years as well? Like as a little bit of the thought too. We're all kind of in this ecosystem and kind of the next wave of investors here, kind of going from that operator founder into the investing realm. And like, are they someone that I would want to share deals with? Like, do I trust their judgment? Yeah. So I don't know. There's a lot of things, but it's very much like investing in an early stage startup and an early stage founder.
No, totally. So what I'm hearing is, do you want to be stuck on a desert island with them? Is the criteria? No.
There's part of it. There's part would I work for them? I mean, it's the same thing like a founder. Like you ask yourself, like, would I work for this founder? Would I join this company? Like, would I work for this GP? Would I join this firm?
I mean, in many ways, some of the advice I give founders when they're taking money from investors is you are getting married, essentially, and divorce is painful. Are you ready for that? Are you committed to that? And so I think people take that a little bit lightly sometimes. So I like to hear that, like, that's a really, key part of your assessment. Building a relationship is about the long run, and that needs to be like heavily weighted in everything you do.
One little maybe quote on that one. Then someone said it recently, and it was top of mind, but I'm trying to play long-term games with long-term people.
I love that quote too. So on the subject of Twitter personalities and celebrities, we're kind of now right at time for our trending Twitter portion. And what we really want from you is some hot takes on this. So I tried to get some good ones. Nothing came out that was like super salacious and juicy, but we got some good ones. And so I will share for everyone to see here, and I'll read it off for you. And then I want you to dive right in. So this one's from Kieran Hill, is with 20VC. What makes the perfect angel? Asked a seasoned founder today, and response was 1, signs documents quickly. 2, don't only send links to emerging competitors. 3, don't be an asshole / make life difficult. 4, better than me at one thing. You think this would be simple, right? Crying or laughing emoji, face with tears. So, Nick, what do you think? Did he hit the nail on the head? Do you have 5, 6 N numbers to add? What do you think?
Well, one, I love number 2. That's hilarious. Don't only send links to emerging competitors. I see that. And there is an urge every time I see this. I think that one's hilarious. I really like be better at one thing to me. I think a founder should look at angels the same way they would build an advisory board, the same way they should build their executive team. There's different angels that fill different roles, and you need to assess your own capabilities, your team capabilities, and plug the angels in where you need. I think the other stuff of sign documents quickly, don't be an asshole, like that, maybe be better than me. Like it's table stakes, but I really look at it as like, what do you need on your team? You're putting together a group, and an angel is part of your group and part of your team.
I love the number 2 because I'm guilty of that at times, but I really try not to do it, only if it's interesting.
Right.
I the one thing I would say is like 5. For me, having written just a piece about taking small checks last week, and the thing that stood out for me was really like the point of taking those small checks is like the money multiplier leverage that it can get. Like I would say number 5 for me is, are these people going to get you more intros, money, whatever it may be that you need? Like take money from people that are going to provide leverage for you operationally, financially, whatever it may be. That's the number one thing from an angel perspective. Obviously, you like people that come in early and have high conviction, right? Like that's part of this, but they also probably need to bring some leverage for you. So that's one way I think about it. Let's go on to the next one. This one is from Jesse Tinsley. We'll pop it up here. We haven't talked about YC yet, so I'm excited to talk about this. So interesting observation. This YC batch is the strongest in the past 3+ years. My hypothesis, with less promising job prospects, some really amazing founders built great companies. Great time to be an angel investing, and not a slight at any of the previous batches. So quick tinge of color here. One, definitely spouting the conventional wisdom that layoffs equal more amazing people working in startups. Don't know if that's true or not. Definitely is conventional wisdom, it seems, at this point. And 2, There's a lot of AI startups in the YC batch this year. What's your take? Do you think it's the best one in 3+ years? What's your feeling here?
Yeah, I mean, I'll be totally honest and truthful. I don't have the comparison to judge on the past batches to know where this one compares to the other. Building in Indiana for the last 8.5 years, pretty heads down. Checking out the new YC companies wasn't something that I've particularly kept up on. That being said, I have heard really great things. I have heard there's a lot of hot AI startups. I am invested in a couple, call it micro funds, that have other GPs out there just investing in this batch of really good things. Given all the macro and what you said about the founders and people getting laid off, I'll buy it. I'm buying. I don't know if I have a lot to add, but I buy.
Is that more because of the AI focus that you're liking it, or like I know you kind of mentioned you've been looking more in that space, so just intrigued if that's a factor.
It 100% is a factor. I mean, the fact ChatGPT came out in November and it is wildfire. Like, it's changing the world. It is crazy how fast things are moving, and it's still interesting to see like what the defensibility model around a lot of these startups are going to be. So I'm not the AI expert, so I'm not like gun just out there blazing. I'm really trying to sit back and learn and put some money in some other GPs that do have more expertise in those areas.
Well, that's kind of the end of the show for us. We've gone through the trending Twitter threads. We appreciate your hot takes. We've loved having you on, and thank you for educating us on vertical SaaS. I know I learned a lot from that. Last thing I would just ask is, you got any parting wisdom for angel investors out there, people looking to get started? What would be the one piece of advice you wish you had gotten?
Get started earlier. It doesn't take a lot to get started with 1, 2, 3K checks, and it didn't have to be 20, 30, 40K checks. So if you're interested in this stuff, there's a lot of way to get involved. You guys have had some great angel groups on here. Vitalize Angels was one that I'm involved in or as a member before. But there's tons of great ones out there. So I would just say, get out there and get started earlier, because your learning will just compound.
That's the call to action. It's just such a thread that like people can get started with smaller checks. I agree. My main regret is not starting earlier and knowing I could do that, because I was like you. I was like, 25K check. I got to have a lot of conviction. I think, as Kirk said, spray and pray with small amounts of dollars can be really powerful. Granted, do your due diligence, things like that. But the point being, like, the opportunity exists, and you can actually go out there and get good deal flow at small check sizes. So I appreciate that. All right, Nick, thanks for coming on and to get this up and published and out to the great angels out there.
Awesome. Thanks so much for having me, Colin. And yeah, if you want to follow I'm on Twitter at Tippman, and on LinkedIn, doing 30 posts in 30 days. So if you want to come follow along,
oh wow,
we're on LinkedIn at Nick Tippmann. So would love to connect.
All right. Instant follow and like.